Banks are refusing to lend to some of the most successful business owners in America. Now, not because they're bad borrowers, but because they're too smart with their taxes. I'm Benny Rabashin, and after 21 years as a mortgage advisor, I've seen this pattern repeat hundreds of times. Today, I'm exposing why this happens and the 3 alternative solutions banks don't want you to discover. Okay, picture this. You run a thriving business. Last year, you deposited $2.3 million in revenue. Your bank accounts are healthy. You have excellent credit. You walk into your bank for a mortgage pre-approval, confidently you'll be approved. Then you get the letter, denied, insufficient income. Now, how is that possible? You just showed them $2.3 million in business revenue. Here's what's really happening. Traditional banks only look at one thing, the bottom line of your tax returns. And if you're a smart business owner, you've been working with your accountant to legally minimize your tax liability through write-offs, depreciation, and strategic business expenses. Now, your actual financial picture shows strength, but your tax returns, they might show $50,000 in income or even a loss. Banks see that number and immediately decline you. They don't look deeper. They don't analyze your business model. They don't even consider your cash flow, your assets, or your business acumen. They just see a number that doesn't fit their rigid guidelines and they say no. I've helped over 2,500 families secure financing, and I can tell you this refusal pattern isn't about risk assessment. It's about outdated lending criteria that punish entrepreneurial success. Let me be direct about why traditional banks refuse to adapt. It comes down to 3 factors. First, they're using lending guidelines designed for W-2 employees, not business owners. This criteria were rebuilt decades ago when self-employed was rare, financial structures were simpler. Second, analyzing business financials requires expertise and time. Looking at bank statements, understanding seasonal cash flow patterns, evaluating business models, this takes specialized knowledge. Most traditional bank underwriters don't have it and don't want to develop it. And third, banks prefer the path of least resistance. A W-2 employee with consistent paychecks fits neatly into their automated approval systems. Self-employed borrowers require actual underwriting work. So rather than evolving their approach, they simply refuse to serve this market segment. They'd rather lose your business than adapt their 30-year-old guidelines. This creates a devastating cycle. Business owners are told they need to show more income on their taxes to qualify for a mortgage. So they have 2 choices. Either pay thousands more to the IRS just to impress a loan underwriter, or give up on real estate ownership. Now, both options are absurd. Why should you sacrifice your smart tax strategy just to satisfy outdated lending criteria? And why should successful entrepreneurs be locked out of real estate wealth building? The answer is simple. You shouldn't, and you don't have to. What banks won't tell you is that alternative lending programs exist specifically for business owners like you. These programs recognize that reported income and actual financial strength are 2 completely different things. I'm going to walk you through 3 specific strategies that let you secure real estate financing without changing your tax optimization approach. These are the solutions banks refuse to offer because they require actual underwriting expertise. Solution 1, bank statement analysis. This first strategy is bank statement lending. Now, instead of relying on tax returns, we analyze 12 to 24 months of your business bank statements to determine actual income. Here's a real example. I worked with a client who owned 2 pawn shop locations in California. His business was thriving, $1.8 million in gross revenue flowing through those locations annually. But he worked with a strategic accountant who helped him maximize business write-offs. Between inventory costs, employee salaries, rent on 2 locations, equipment, and other legitimate business expenses, his tax return showed $82,000 loss in 1 year and $112,000 loss the next year. He went to Bank of America, where he'd banked for years. They looked at the bottom line of his tax returns and immediately declined him for the $1.3 million home he wanted to purchase in Tustin. His real estate agent referred him to me. We took a completely different approach. Now, instead of looking at what reported to the IRS, we analyzed the actual business bank statements. We could see every deposit, every withdrawal, every transaction. We could track seasonal patterns, identifying recurring revenue streams, and calculate his true cash flow. Now, based on those deposits, that $1.8 million in actual business revenue, We calculated qualifying income that reflected his real financial strength, not his tax-optimized reported income. The result? Approved for the full $1.3 million purchase. And he continues running his business with the same tax-efficient strategy that makes financial sense. Asset-based lending. The second strategy focuses on your assets rather than reported income. Many successful business owners are asset-rich but deliberately income-light on paper. Now, I had a client who built a real estate investment portfolio worth $3.2 million. Smart guy. He structured everything through LLCs, reinvested profits into new properties, and used depreciation to minimize taxable income. On paper, his personal tax returns show he made $45,000 a year. Traditional bank underwriters saw someone barely scraping by. But the reality? He owned multiple cash-flowing properties with substantial equity. He had proven real estate experience. He had significant liquid reserves. His actual financial position was incredibly strong. Using asset-based lending programs, we secured financing based on his portfolio value, his business acumen, and his demonstrated ability to successfully manage real estate investments. His reported income was irrelevant. What mattered was his actual wealth and proven track record. He acquired 2 additional investment properties that year, growing his portfolio from $1.4 million while maintaining his tax-efficient structure. Now, this is the approach banks refuse to offer because it requires understanding business strategy and wealth building, not just reading a tax return number. Debt service coverage ratio. The third strategy is called debt service coverage ratio, also known as DSCR. Now, this is particularly powerful for investment properties. Instead of focusing on your personal income, we evaluate the property's ability to service its own debt. Now, I worked with a restaurant owner who came to me after 3 bank rejections. His restaurant was successful, but between equipment depreciation, food costs, labor, and rent, his personal tax return showed break even or even a small loss. Traditional lenders saw no qualifying income, automatic decline. But he wanted to buy a rental property that would generate $4,200 a month in monthly rent and mortgage payment of $2,800. Now, the property's cash flow more than covered the debt service. Using debt service coverage ratio lending, we focused on the investment itself, not his personal tax situation. Now, the property generated sufficient income to support the loan. That's what mattered. Approved. He's now building a rental portfolio that complements his restaurant business, creating multiple wealth streams without sacrificing his business optimization. Here's the bigger picture. Business owners like you are the backbone of the American economy. You create jobs, you build value, you take calculated risk and generate wealth. You shouldn't be punished for understanding how to legally minimize tax liability. That's not financial irresponsibility, that's financial intelligence. These alternative lending programs recognize what traditional banks refuse to acknowledge. Reported income and actual financial strength are not the same thing. Banks refuse to offer these solutions because they require expertise, analysis, and willingness to understand how successful business actually operates. It's easier for them to say no than to do the real underwriting work. But that refusal is creating opportunity for specialists like me who understand both business finance and creative lending solutions. Listen, if you're self-employed and have been refused by traditional lenders, understand this. That rejection isn't about your financial strength. It's about their inability to properly evaluate business owners. I've created a comprehensive creative financing guide specifically for business owners and self-employed professionals. It breaks down all the alternative loan programs available and explains specific qualification requirements and includes detailed case studies like the ones I shared today. To get immediate access, send me a direct message with the word creative and I'll send it right over. And if you're ready to explore these options for your specific situation, I offer a free 20-minute discovery call where we analyze your business structure and identify the best financing path for your real estate goals. The link is in the description below. Let's build a strategy where your tax optimization and real estate wealth building work together instead of against each other. I'm Benny Rabishin, and I specialize in getting approvals when traditional banks banks refuse. If this exposed something that you didn't know about alternative lending, subscribe for more insights on creative financing that actually works for business owners. Remember, banks refusing to lend to successful entrepreneurs isn't about risk. It's about their unwillingness to do the work required to properly evaluate business owners. You don't need to change your tax strategy. You just need a lender who understands how to assess your actual financial strength.